Stam, and I'm the Manager of Marketing and Membership for the Robotic Industries Association, and I will be serving as your moderator today. Attendees that have joined this webinar have joined in listen-only mode, which means that you are muted. If you do have a question during this webinar, please submit them in the questions panel of your webinar screen, and we will answer questions at the end of the webinar. This webinar will be recorded, and a link will be sent to you within the next 24 hours. I'd now like to introduce our two presenters for today's exclusive webinar, Sarah Russell and Tim Finerty. Joining Clayton and McKervey in 2000, Sarah is an owner and point person for implementing tax strategies to help reduce tax liabilities, including maximizing profits with tools such as the Research and Experimentation Credit. She helps owners and executive teams with international tax consulting and compliance, looking for big-picture solutions to advise clients on global operational structuring, foreign tax credit utilization, and tax treaty analysis. Sarah works with companies expanding both within and outside of the U.S. in a variety of industries, including automation. She values the opportunity to collaborate with both accountants and tax specialists globally on behalf of the firm's clients. As an owner of the firm, Tim leads the firm's assurance practice with the responsibility of conducting audit, review, and compilation engagements for both domestic and foreign-owned subsidiaries. As practice leader for Mexico and Latin America, he is particularly attuned to the needs of small and mid-sized growth-driven businesses in the manufacturing, distribution, and automation industries. An advisor to these companies since 2001, he is focused on helping clients reduce tax burdens with ideas such as the Research and Experimentation Tax Credits. I'd also like to thank our exclusive sponsor for today's webinar, Clayton and McKervey. Clayton and McKervey is an accounting and business advisory firm that specializes in international tax, assurance, and accounting services. Their clients are middle market companies competing in the global marketplace. They are headquartered here in the U.S. and around the globe. At Clayton and McKervey, we think and act like entrepreneurs because our clients are entrepreneurs. With that, I'd like to pass on the presentation to Tim. On to you, Tim.
Thanks, Sophia. Appreciate the introduction. I wanted to, before we talk about our topics, I wanted to just welcome you guys all to the webinar on maximizing tax savings. And this webinar, we felt, there's a few different tax savings that are out there for system integrators and automation companies. But we really felt right now that the R&D credit is a huge opportunity for the system integrators and automation companies. So we'll get into why we believe that's the situation and some of the different things. If there's some leftover time at the end of the presentation, we may touch on one other tax savings idea, which is known as the IC DISC, which is related to companies that are doing a lot of exporting. So they'll manufacture the product here but export. So with that, I'd like to talk about our topics for today. The first one we're going to cover is just kind of a little overview of the credits. We're going to give you some examples of some of the savings that we're seeing right now, and then we'll get into kind of the nuts and bolts, the qualifying activities for the Research Tax Credit and the other eligible activities and expenditures that are out there. With that, wanted to start briefly. One of the things that's really interesting out there related to the R&D is that people I hear throughout my client base or on the street is that, I don't think I qualify for it. And you can see with this statistic out there that many people are not taking advantage of it. Really only 5% of people are taking true advantage of what the R&D credit is available out there. And we'll get into what some of those differences are with some of the examples and the detail. Sorry about that. So one of the things that a lot of people think about when they're thinking about whether or not they qualify is they look at what the traditional definition of research and experimentation. And most people think it's got to be new to the world. I got to have a patent or something else. But really, the tax definition, which is much easier to satisfy, is just new to you. You know, you just have to make an improvement in your process, and therefore it would then qualify. So we'll kind of go through what the top 9 myths are out there. The first one, the R&D credit is only for companies that invent something revolutionary. Again, in reality, the R&D credit is designed to encourage innovation. As such, it is equally available to companies that attempt evolutionary improvements to existing products or processes and companies that undertake revolutionary activities. So it's just you have to continue to improve. The R&D credit is only for companies engaged in basic research. This one is, you know, it extends to the applied sciences. So it's the different sciences. We'll get into some of that. And it's just through the processes of using technology and science. So if you're improving the process by making it easier by, you know, from a technology standpoint, making it over the air or cloud-based rather than system-based, those are some of the things that can qualify as well. Myth 3, the R&D credit is not available for companies that fail in their research. And that's one of the biggest things. It's one of the things that the tax code looks at is they like to see failures. That means that there is cost that you're incurring that you're not getting paid for. And that's really one of the biggest things. Myth 4, the R&D credit won't help my company because my company is not profitable. This one is definitely an interesting one to a lot of people. You know, the credit carries forward for 20 years and back 1 year. So if you weren't profitable, you know, right now, but potentially in the future or upon sale of the company, you could utilize those credits. And if you don't take advantage of doing the study now, you could lose out on those credits in the future. There's also, we'll kind of talk a little bit more in detail on it, but with the new Tax Act that was passed in December, there's the ability for startups to use some of the credits against payroll taxes. Myth 5, the R&D credit is only for big companies. If you really think about it, right now there's about 50% of companies that are below 5 million that are taking advantage of the credit. And one of the other studies that are out there is about 90% of all companies are small to mid-sized businesses, meaning under about 500 million in revenue, but even less than that in most cases. Myth 6, the R&D credit is not available, does not help with state taxes. That's untrue. In a lot of states, there are credits out there, and we'll kind of go through those things later on as well. Myth 7, the R&D credit is not a big deal because our company is already getting the deduction. That's one of the biggest areas as well, is that if you elect the code section 280C, it allows you to take a reduced credit for the R&D expenses, and therefore you take the expense on your P&L as well as getting the credit for it. Myth 8, R&D credit is not available to my company because research is funded by the government. And again, the portion that's funded by the government, you're probably not going to get the credit for, but any other cost that you incur, you will get the credit. And number 9, the R&D credit is for increasing research. Since my spending is flat, my company is not eligible. And that's not true, and we'll kind of go through that in one of my first examples that I give here. So I wanted to go through about 4 examples of kind of some of the things that are out there and some of the credits that we're seeing before we get into the nuts and bolts, just to kind of get your juices flowing for understanding how much potential cash is out there, especially for the system integrators that are doing unique cells throughout their process. So the first one is, this one is a company that we've been doing work with for a long time. However, they have not had increasing research in the past, but they're just kind of steadily doing research, but it's not increasing each year. And so it's a company that provides intelligent assembly automation and test systems with customized design and build for the automotive industry. They're an S-Corp with one shareholder. They have annual sales of about $30 million, and their qualified labor is about $2 million, and their qualified supplies is about $2.3 million. Their credit is still $154,000 a year. However, over the last few years, their sales has increased and their qualified labor and supplies has kind of stayed the same. So their credit that they're generating has gone down a little bit, but it's still a very significant credit. The next one here is a system integrator that's engaged in the design and build of automated welding, material handling, and assembly solution systems. They're an S-Corp with 4 shareholders. They have annual sales around $18 million. And they have qualified labor of about $1.2 million. And this was before they became a client of Clayton McKervey. And as we were looking at it, so the credit before Clayton McKervey was $80,000. After we started to understand what they were doing, we were able to increase the qualified labor to $2.7 million and get qualified supplies of $6 million. And Sarah will go through kind of the details of how that and why that qualifies. But it is one of the areas that we really want system integrators to understand, that the supply cost of their cells, if considered unique in nature, each one of them can qualify for supplies. And therefore, you can see the increase in the credit is tremendous. Almost $500,000 additional cash flow that the company is able to have. So another one, it designs, develops, builds state-of-the-art automated solutions for automotive, medical, computer electronics, and consumer goods. It's an S-Corp with 2 shareholders. It's got annual sales around $20 million. It had qualified labor of about $1.5 million before we took over the account, and was getting about $100,000 credit beforehand. It's now up to $2 million of qualified labor and $4.5 million of supply costs. So the credit is about $425,000. So again, another significant amount of cash being generated, or less tax being paid to the government. The last one here is a design and build integrated assembly equipment for automation, assembly, and weather systems. This company is an S-Corp with 1 shareholder, annual sales of $12 million, and had 0 qualified labor. So they weren't even taking advantage of this credit before we picked them up as a client. After we picked them up, we identified the R&D credit. They had qualified labor of $1.5 million and qualified supplies of $3.8 million for an R&D tax credit of $275,000. So you can see the tremendous benefit that is out there if this is being done to its fullest advantage. So hopefully this gives you a little flavor. We'll kind of get into the nuts and bolts now, and I'll turn it over to Sarah.
Thanks, Tim. I think those are great examples which demonstrate how companies aren't taking full advantage of the credit, even if they are currently utilizing it. I'm going to go over some of the details about what activities and expenditures qualify now. I want to start with a few key points. Sorry about that. The first point is that the R&D credit is governed by Internal Revenue Code Section 41. It's based upon qualified research activities, and there are 3 types of expenditures which are eligible for the credit. If you receive a refund of tax from the IRS, that refund will be tax-free, and the credit is filed on Form 6765, which will be included with your federal income tax return. There are more than 35 states that have a similar program in addition to the federal tax credit. So one of Tim's myths was that the credit doesn't impact your state income taxes, but depending on where you're doing business, it could. Michigan is not one of those states, but if you're paying taxes in other states, potentially there's additional credits out there for you. One of the reasons why we wanted to have this webinar today is because at the end of December, there was some new legislation passed as part of the Protecting Americans from Tax Hikes Act of 2015. And what happened when that legislation was passed was the R&D credit was made permanent. Previously, the credit had to be extended every year, and oftentimes that didn't happen until the end of the tax year. So as a taxpayer, you couldn't plan for the credit. You couldn't count on the credit being there, and you had to go through the whole year without thinking about the credit. The second thing it did is it turned off alternative minimum tax for taxable years beginning in 2016 for qualified companies. We'll go over what that means a little bit later. And one of the third things it did is startup companies may now claim the credit against payroll taxes for taxable years beginning in 2016. And what that means is in a startup, and I'll define that a little bit later as well, but a lot of times a startup company may not be paying any income taxes, so they would say, it doesn't make sense for me to look at this credit because I'm not even a taxpayer yet. But in reality, you could save against payroll taxes instead of just federal income taxes if you're considered to be a startup company. A few other items that were passed through regulatory guidance. You're allowed to take the alternative simplified credit. Election can be made on an amended tax return. Previously, the election had to be made with the originally filed return. That's no longer the case. They brought in the definition a little bit of a research expenditure under Section 174, and then they also included internal use software development. So when I talked about the AMT issue, we really feel like this credit, the updated legislation, allows taxpayers to monetize their credit faster. And it's especially beneficial to companies with average gross receipts over the last 3 years under $50 million. And the reason why this is for those companies whose average gross receipts over the last 3 years is under $50 million, there is no alternative minimum tax limitation. Before this piece of legislation was enacted, a taxpayer could previously reduce their effective tax rate from about 40% to 28%. And that's because that's what the alternative minimum tax rate is. Since this has been turned off with respect to the credit, a taxpayer can now reduce their effective tax rate from 40% to about 7.5%. You can see that's a very increased difference in the tax benefit this credit is now generating.
Sarah, just one thing to point out. I think from the examples that we gave earlier, you could see the increases in the credit from what we had talked about or saw to start with of 100,000 up to the 500,000. And this now, with the turnoff of the AMT, allows you to potentially maximize a lot more of that going forward. And so it really makes a whole lot of sense to make sure that you're doing it correctly moving forward into 2016 and beyond.
And it allows you to utilize that credit faster. What we saw in the past before the AMT limitation was shut off was that even clients that were generating significant credits might not have the taxes being paid, so they would be carrying forward credits up to 20 years, but typically they would use them over the next 10 years. With that AMT turnoff, without that limitation, they're able to utilize a much larger percentage of the credits that they're generating in the current year. And then the other item that we talked about was startup companies able to utilize the credit against payroll taxes. And a startup company is a company that's less than 5 years old and generating under $5 million of gross receipts. And they can use that credit to offset up to $250,000 of employer-related payroll taxes. So in general, when we're talking to our clients, we tell them, what is the value of the credit? You can sort of count on for about every $1 million of qualified research expenditures, up to $65,000 of R&D credits would be available. That's just the federal credit. There could be additional state tax credits available as well.
One other thing to just point out there, as you look back at those examples, you can see the first example that we gave, it didn't have, you weren't really getting 6.5% on every $1 million. You were getting a little bit less. And that was because, in their case, they were not increasing their research. What was qualifying was decreasing a little bit. So they still got credit, but not to the full extent. But as you could see on the other 3 examples, they were getting pretty close to that $65,000 for every $1 million of qualified research expenditures.
Yep, that's a good point, Tim. At this point, you're probably thinking, what is a qualified research activity? So qualified research activity is the development or improvement of business components. And I want to stress improvement of business components because we find that this is a place where most companies fail to take full advantage of the credit. A business component has a pretty broad definition. It can be a product, a process, a technique, formula, invention, or software application. There's also some technological criteria to be aware of, but again, the criteria cover a pretty broad scope of principles. The process of experimentation must fundamentally rely on principles of science, including physical, biological, engineering, chemical, and computer sciences. A qualified research activity must also have some sort of elimination of an uncertainty. If information sought must be intended to eliminate uncertainty, and the IRS says uncertainty exists if at the outset the available information does not establish the taxpayer's capability of developing or improving the business component, method of developing or improving the business component, or appropriate design of the business components. There must be a process of experimentation, and experimentation is the evaluation of multiple alternatives, including developing and testing hypotheses, modeling, simulation, and systematic trial and error. It goes beyond the lab, and it includes both conference room and shop floor experimentation time. And this is important as we get into qualified expenditures, you'll see, because it can include some administrative time, not just what people would typically think of as research time. And then the research must substantially relate to new or improved, and there's that word again, improved, function, performance, reliability, or quality. Some examples of qualifying activity include providing custom control and automation solutions for various applications, developing new functionality or performance to meet customer specifications. And that's an important one because if you think about, especially in the automation industry, you know, you guys are constantly developing new processes or procedures to meet your customer specifications. And so you may not be creating something that's brand new to you, but you might just be tweaking a project or a process or a cell so that it meets a certain customer specification that you had never done before, and that activity would be qualifying activity.
You know, one example on that is just thinking about if you're doing automotive, would be when you're doing something that's almost similar, but it's for a different platform, your design has to be a little bit different. So you're improving that process within that platform that you're working on. If it's, you know, the Ford Mustang compared to the Jeep Cherokee, you know, each one of those would be separate and potentially could qualify depending on the activity.
That's exactly right. Other qualifying activities include developing schematic drawings for integration of system components, designing and developing cost-effective and innovative operational processes, developing new tool-specific fixturing or other tooling, improving processes through robotics or other types of automation techniques. And that could be as simple as Tim mentioned, you may be working on something similar but for a different platform, that may require you to move robots around to somewhere different on the machine, and that type of activity would be a qualifying activity. Experimenting with new alloys or materials, testing new mold or design, or new mold or die designs through sampling or trials, providing product and system solutions, including design, engineering, and mechanical fabrication, performing evaluations and system tests, and implementing automated systems. Now we'll talk a little bit about qualified research expenditures. What types of expenditures qualify? Well, there's 3 types of expenditures, and those are wages, supplies, and then 65% of contract research. Supplies, we find, is the most commonly missed expenditure and is often the greatest qualifying expenditure. As mentioned in previous slides, since integrator automation industry often customizes each project, supply costs for each project are typically qualified. However, if you built 4 identical cells for the same customer, only the supply cost for the first cell would be a qualifying cost. So keep that in mind as you guys are going through this and thinking about what types of costs would qualify. We also see some misses in the wages, the qualified wages. I mentioned before that shop time and conference room time could qualify, and that's where you want to make sure you're capturing your wages on your projects. You could have an administrative assistant that's in a meeting taking notes. Her time may qualify on that project. So these are just a couple of items we wanted you guys to keep in mind.
Just one thing related to the contract research. The reason that it's 65% is because you're paying an outside company and you're not paying all the payroll taxes and different things like that. So they qualify that at 65%.
So next we're going to talk about integrating tax planning with Section 41, which is the Internal Revenue Code section, which governs the RNG credit. So there's a few utilization factors you would want to consider when thinking about the R&D credit. A lot of times we hear, well, I have net operating losses, so I'm not going to do anything about this credit until I've completely exhausted my loss carry forwards. And sort of our rule of thumb is if you are a year or 2 away from exhausting those carry forwards, you probably want to consider moving forward with an R&D credit study today to ensure all of your documentation is in order to maximize your credit once you are taxable. You know, in Tim's examples, there were clients that went from, you know, that increased their credit by almost $500,000, and that's a big chunk of cash in the first year that you're becoming taxable, especially if you hadn't been paying taxes for several years. And so we encourage our clients to move forward with those studies in advance of when they actually become taxable, because it gives them enough time to make sure their documentation is in order.
One thing that we like to look at too is ultimately what is going to be the cost in the out-of-pocket cash flow, because if it's not going to make sense for a while, you know, I know from a small to mid-sized business owner, cash is king, and therefore it really has to be looked at. However, you know, there are some differences. You are able to, with the R&D credit, go back 3 years for federal purposes to do the study, and there's some other little nuances, you know, that you can go even farther back depending on certain circumstances. But it's always easier to do the study in the current year because of documentation costs and everything else.
The other utilization factor, and we talked about it, is the alternative minimum tax impact, if any. If you look at your average gross receipts over the past 3 years, and you're approaching that $50 million mark, you may want to consider, you know, planning your shipments, so that if you need to move revenue from December into January, if you ship something in January, and it'll make sure that you still qualify and you meet that the AMT limitation, so that AMT isn't an impact. Think about those things in advance so that you can maximize your full benefit of the R&D credit. Passive ownership is another area that we run into quite often. especially with family-owned businesses that are approaching succession issues. We have a lot of clients that sometimes will gift ownership to their children who are not involved in the business, and they're considered to be passive owners. Passive owners typically won't be able to utilize the R&D credit as effectively as an active owner. So that's something you want to take a look at if you're considering gifting stock to a child or someone else or another relative, and you're taking the R&D credit. Think about how that gift is going to impact your utilization of that credit. ESOP owned, if your company is ESOP owned, you're probably not going to get a benefit of the R&D credit because the ESOPs aren't taxed.
One thing that we've been seeing is that some of the transition of succession to management or to other people is through an ESOP, and it's a great way to help with the cash flow because you're not paying the taxes. However, with the new rules on the R&D, if you're an integrator that's generating $500 to $1 million of credits, you're almost reducing your tax down to zero through the credits, and therefore an ESOP isn't a good option, or meaning that you don't have to look at the ESOP as an option. It could be just going the regular route and still having management be able to buy it out because of the tax-saving benefits that are out there. So it's an interesting thought process for succession planning as well now with some of the changes that have been made.
Good point. 41G is a special subsection of the code that governs the R&D credit, and Tim is going to get into an example on that in just a few moments. Statutory deadline considerations. If you're sitting here in this webinar thinking, wow, I may not have used the R&D credit to the fullest extent under the law. There are qualified expenditures I think I have that haven't been included in my calculation. You can go back and amend returns to claim the higher credit. It's just important to know when your last return will fall off. The statutory deadline allows you to go back 3 years, which it's 3 years from the day you filed your return. We have had an issue in the past where, we've had a new client and they said, well, I filed my return on my last day possible. I filed it on the extended deadline, which for this client was December 31st or December 15th. They were 3/31 year end. And so we amended the return and we filed it, I think it was on December 14th of the year that it was going to drop off. And the amended return got rejected because the statute had already passed. In fact, the client had filed the return on December 12th, so they missed the deadline by 2 days. So that deadline is very important, and you want to make sure you know exactly the day that statutory deadline is going to occur. And then there are group considerations that are out there. If you have more than one company, there could be, you would be considered a controlled group, and it could impact your AMT limitation and your credit utilization. So those are just a few of the items that could impact your utilization of the credit. The AMT example, I just wanted to go through a quick example of how big a difference this could be as far as credit utilization. Assume the entity is an S corporation. If AMT applies, if you have income of $1 million, you have regular income tax of $400,000. Your R&D credit would be $120,000 because of AMT limitation. Because your AMT, as we mentioned before, is 28%. So your tax liability would be $280,000, which is 28% of $1 million. With the AMT turnoff, that tax liability is now $75,000. So it's an additional cash savings of $205,000.
So as you're looking at that, for every $1 million, basically with the new regulations of income, $1 million in income, you can generate $205,000 of cash flow savings, a reduction in tax. So, I mean, you're looking at a 7.5% tax rate if you have credits to be utilized.
That's right. So we talked a little bit about having the right documentation in place. You may be wondering, what is my required documentation? What do I need to have? And sort of a good rule of thumb is job descriptions for each employee. You want to be tracking time for each employee by project, and that includes all employees who are involved in the project. Administrative employees to support the project should be billing time to the project. If they're involved in conferences, taking notes, any of those types of functions, that time should be billed to the project. So you just want to make sure that you're capturing the time for all employees who touch that project. Supply cost by project, we've talked a little bit about that, how important it is to understand the supplies you're using for each project. And then contract research costs by project. Typically, if we were going to go out and do a study, we would require all of this information as well as the support to provide that, which would be GL detail reports, W-2 reports, and that type of documentation. But this gives you a good overview of the type of documentation you would need to be able to support your R&D credit as well as maximize the credit. I'm going to let Tim go through the 41G credit.
One thing before I get to that example, regarding the time tracking, we've found in the past that at least most engineers are pretty are keeping some sort of notes somewhere, you know, and this is where as you start looking at it and get into really understanding the R&D credit, where you can set up better information for them to be able to track it in a different spot that can be captured when the study is done. So here's the 41G example that I kind of want to go through it. So what this means is the 41G, just a really quick, is allows you to potentially utilize credits that are above where your tax would have been when you hit the tax that you have on the income generated from the activity. So here is the example. So what we did here is this was for a company that in 2012 generated $217,000 for its credit for increasing activities. So that was the credit for R&D. It had ordinary income of $234,000, which was the S-corp income. It had some, different losses here, DPAD adjustment, some other things. It had W-2 income. This is the individual. It had about $200,000 and then some other income. So there was AGI that was attributable of $391 and total AGI of $421,000. So of that, 93% was attributable to the activities that the credit was generated from. We had some itemized deductions and different things that came down to a taxable income of $308, and our total taxable income was $331. So the $308 is the taxable income attributable to that research credit. You take the tax that was related to that, and it was $86,000 was the tax for the year, and the tax attributable to the activities was $80,000. So my general business credit that I had was $80,000 of credit, and the remaining amount was this 41G that was generated. And what that means is now that tax, the $136,000 of credits that I've generated, I can carry back 1 year or carry forward, and I can utilize that against AMT. So going back to the example that we gave, where you get limited at the 28%, you now can utilize this $136,000 of additional credits, and it's going to vary depending on the years and the different calculations. But that amount allows you to utilize that against AMT as well. And so that's one of the significant things that we've seen recently on some of our clients, where they would get limited as an S-Corp shareholder in 2012, 13, 14, and 15, that they would get limited by the credit because of AMT, but because they were generating such big credits, they were able to utilize some 41G credits that we could go back and go forward up to 2015 and beyond. But it is a significant potential cash flow savings, or really additional cash that can be generated back to the shareholders of S-Corps or LLCs if there is this difference between, the regular general business credit generated and the 41G. And it's all going to be dependent on, what the ordinary income is, what the W-2 wages are related to that activity that you're doing. So with that, I think we've kind of gone through a lot of information. I see a few questions here that I'd like to start and open up to even more, but I got a few questions that I'd like to ask Sarah. The first one is, why wouldn't my CPA have made me aware of the R&D credits?
That's a good question. It's a question we get quite often when we're talking to new clients. And really, there's probably a few reasons. It's previously mentioned, the first reason is the credit was just made permanent. So prior to the recent legislation, as I mentioned before, taxpayers didn't know whether the credit would be extended until the end of the year, and you couldn't plan for it. Another reason is this is a highly specialized area, and sometimes general practitioners who are doing a little bit of everything aren't well versed in the ins and outs of the credit, so they may not realize that the activity that you're doing actually qualifies. You really need somebody who understands the ins and outs of this credit and the digs deep into the code section to understand what activities you're doing that could qualify. And then another reason is that I think a lot of people have really missed out on this is there was a recent court case called TG Missouri, which ruled that taxpayers could include costs of purchase molds that are sold to customers when calculating their credit. And the facts of the case have been used to expand the definition of qualifying supply costs to include costs for which the taxpayer is at risk. And there's some pretty detailed definitions about what type of costs are at risk, but the high-level overview is the taxpayer is considered to be at risk if you're paying for the supply, regardless. Regardless of whether or not you've drawn your cell in a manner and you've bought the supply and in the end you don't use the supply is not successful in that cell, but you're still going to pay for it, then you are deemed to be at risk. In addition, you're deemed to be at risk if your customer isn't going to pay you until whatever you're providing to them is successful.
So if my customer pays for the supply, like the robot, does that qualify? Do I get to qualify that?
You get to qualify for it.
So if the customer itself, though, is paying for the...
If the customer directly buys the supply, you do not qualify for it. If the customer buys the supply, if that supply is included in the cost of the machine you're selling, then that cost would qualify.
So based off of that is one of the things that we've talked to a lot of our clients as well in this either system integrators or as Sarah mentioned, the TG Missouri case was based off of plastic injection molds, and is that if because of the significance of the supply cost in the qualification of the R&D, because each cell is unique, it makes a lot of sense potentially to buy that supply yourself rather than the customer having bought that. You know, it is a little more cash flow for you up front, but long term it could be a huge benefit.
That's right.
On that one, a little bit added to that, I'd like to avoid an audit related to R&D tax credits. What are some of the precautions for businesses like mine?
I mean, the reality is that you can't avoid an audit. Sometimes it's really just the unluck of the draw, as I like to say, when you get selected for audit. But things you can do to ensure that the credit calculation is accurate and will uphold under an IRS audit would be to get your documentation in place and to utilize service providers who really understand the credit and understand what types of expenditures will qualify and what types won't. Having an R&D credit study done will help you when you need, if you do get audited, to support that credit calculation.
Great. I know you've talked about this a little bit, but we went through it quite quickly. Can you explain what you mean when referencing research and development that is new to my company but not new to the world?
I can. It's been our experience, people think they have to be inventing something new, something brand new to the world, something that they may seek a patent for, or maybe they're not going to go through the process of getting it patented, but it's a brand new invention. And the truth is, the activity just needs to be new to you. If you are customizing a system or cell to your customer specifications, it doesn't matter if somebody's already done that. As long as you've never done it, that activity could be qualifying research activity.
Beyond the R&D credits, are there any other tax savings for integrators or automation companies?
There are a couple. One item that we see a lot of our clients qualify for is called the IC disc, and the IC disc is a benefit that's out there. It sounds like a tax loophole. A lot of times our clients will say that doesn't seem like it's legal, but it is. It's in the Internal Revenue Code. The current administration has supported it tremendously. And really what it is a benefit for people who are exporting goods overseas that are manufacturing or improving processes here in the United States. And really what the IC disc function does is it turns ordinary income into qualified dividend income, which translates to about a 16% tax savings. I'm not going to go through the details of the IC disc, but it is a tax incentive that's out there. Another tax saving strategy that's out there is the domestic production activities deduction. It's another high-level calculation, but typically a lot of our clients save about 9% of taxable. It's a 9% deduction from taxable income. So those are two big tax saving strategies we see out there that automated systems integrators typically qualify for.
One thing on the IC disc that we see, especially now with this AMT being turned off, is that if you're a system integrator and you are making basically unique cells for each project and you qualify all those supply costs, the IC disc probably isn't going to have as much impact because you're qualifying for the research development, and it should be a fairly large number. However, if you're an automation company or a system integrator that's making similar projects, you know, if you're making a cell for the U.S. and then one for Mexico, one for Europe, and one for China, you know, those three that you're shipping out to outside the U.S. qualify under the IC disc, and the original one that you maybe made for the U.S. would have the qualifications on the R&D. So there's different thought processes of when you should be doing, utilizing each one. But, again, I think it's sitting down with your tax advisor, your professionals that understand this, and really taking advantage of what's out there. Sophia, are there any other questions that we missed?
Yes, Tim. We have a couple more questions that have come in here. One of them is, could you please elaborate on qualified wages where compensation is in the form of partnership earnings?
So on that, if you are an LLC, all your earnings come through a self-employment earnings. So therefore, whatever portion of your time qualifies, so does that entire portion. So the benefit there is that all of it potentially, if you're 100% doing R&D and you're a partner in the company and all your income's flowing through, 100% of that time will qualify. Now, the downfall on an LLC compared to the S-Corp, right, is that the earnings there are all self-employment, so you're paying the additional 3.8% of Medicare and FICA that's out there. So your 6.5% should cover that if you're doing 100% R&D, or any portion of it helps save a little bit more money. Hopefully that answered the question. It was a little long-winded.
Great, thanks, Tim. We have a couple more that I will read as well. The next question reads, we are a C corporation with sales under $6 million and 2 shareholders. Does it make sense to make a selection to S corporation?
Well, it depends. I mean, it potentially does. Now, the C Corp itself as well will qualify for this AMT reduction, meaning that as a C Corp, you pay at a 34, we gave an S Corp example on the AMT. On a C Corp, you're going to pay at the 34%, but you get to bring it down to 7.5%. So, I know a lot of people at C Corps, a lot of times they bonus out everything and therefore keep their earnings lower. In the case of still being a C Corp, you wouldn't bonus out as much because you'd want the income so you could reduce the tax. However, when you take the dividend out, yes, you're going to pay at a higher rate. So it could make logical sense to switch to S. But I think one of the things that we looked at was passive shareholders and a few other things. So there could be some reasons that you don't switch as well.
Yeah, there's a lot of factors that go into S versus C Corp election, and it's really fact driven and it's going to be specific to your specific set of facts. So, we truly wouldn't be able to advise somebody over the phone what election makes the most sense for them.
But as you can see up on the screen, we have our contact information if you'd like further advice.
That's right.
All right. Thank you, Tim and Sarah. I will leave this slide up for a minute in case you want to write down the names or take a photo or screen grab. And we are, of course, happy to forward any questions or contact requests to Tim and Sarah. I will go ahead and take over the presentation from here. So moving on to our next upcoming events. We have 2 events coming up in Cincinnati on October 17th through the 19th and also on the 20th. Robot sales are at an all-time high, and robot safety is of paramount importance in automation planning. The RIA National Robot Safety Conference will offer conference sessions and workshops that examine key issues in robot safety and provide an in-depth overview of current industry standards. Accompanying the conference on October 20th is also the International Collaborative Robot Workshop, which is a one-day workshop featuring speakers and industry experts who will share their knowledge on the latest updates within collaborative robot applications and more. You can register by visiting robotics.org upcoming events. Robots are everywhere: industrial robots, personal robots, drones, medical robots, and we are busier than ever. We are building, marketing, integrating, writing languages, interfaces, innovating accessories, watching the new breed of innovators leaving academia, graduating from college, and moving out of their parents' garage to join innovation clusters. From the valley to the alley, from Austin to Boston, we are seeing some revolutionary changes to an industry that has traditionally been more evolutionary. Cheap money and greed, innovation, and startup rockstar people and companies are part of the robot conversation, which is taking place on our June 23rd webinar. You are welcome to join us. There are lots of educational institutions involved in robotics, but the real magic really comes when technology companies, universities, and colleges are able to connect on projects that create value for industry to help them be more competitive and create wealth, jobs, and taxes or taxpayers. On July 14th, we will be talking about partnerships when it comes to tech companies, colleges, and universities. On behalf of the RIA, I wish to thank today's presenters, Sarah and Tim. As a reminder, this webinar has been recorded, and an email with a link to the recording will be sent to you in the next 24 hours. Be sure to visit robotics.org for a list of our upcoming webinars. Thanks again, everyone, for attending today, and have a wonderful day.